Hey there, welcome back to Great Quarter, guys. This is episode 71 of the show where the lines between freight and finance are none. I'm your host, Andrew Cox. I've got a familiar face who hasn't been on the set with me in quite some time. This is my former co-host and executive publisher of FreightWaves, Mr. Kevin Hill. Kevin, thank you for joining me. How are you?
I'm doing great today. Thank you for inviting me on.
Yeah, I'm glad you're here. We've got a jam-packed show. We're going to have a guest in the back half of the show. His name is Richard Metzler. He's the president and CEO of LSO, which is Landstar Overnight. They are a regional parcel carrier based in Austin, Texas. They cover the Texas market, most of Oklahoma. They do some in Louisiana and Arkansas as well, but they are expanding rapidly. We're going to discuss what's going on in the parcel industry right now. We keep seeing peak surcharges added from UPS and FedEx. We're hearing things of poor service on the B2B side. Maybe FedEx and UPS prioritizing the B2C customers and leaving some of the B2B customers out to dry. So we're going to talk to Mr. Metzler about the situation at Landstar and learn a little bit more about the regional parcel industry, because I actually don't know much about it. So I am excited to learn more about that. But before we get going we've got one buy or sell, and I've got a few you care or nas, as well as two charts of the day. I did want to take a moment to thank my sponsor, DDC FPO. This episode is brought to you by DDC FPO. DDC is a business process outsourcing provider that specializes in freight. Perhaps best known for freight billing, DDC recently launched IT outsourcing to help supply chain stakeholders hit development milestones without risking financial performance. Learn more at ddcfpo.com. All right, Kevin, I've got two charts of the day for you. The first one here is, of course, from Bank of America, the best consumer spending data in the country. This is great news for freight market participants, for the general economy. What you're seeing here is the mix of durable goods versus services spending in two of the nation's largest economies, largest states, Florida and California. California there in light blue, Florida in dark blue. The perforated lines are the services spending and solid lines are durable goods spending. What you basically see is that the California services has recovered. It's now above 2019 levels in the state, but durable goods demand has remained really strong in California. The same can be said for Florida. The point that I'm trying to make here between these two states is they are at vastly different paces of reopening. Florida has been open for months now. California just now reopening. So you're seeing that service spend come back slower in California, but it's not coming at the detriment of durable goods demand. That is an amazing sign for freight markets and an amazing sign for the broader economy. Okay, Kevin, you have any thoughts on that chart, by the way?
I know it's good to see California getting open and services really pumping up. I will say that services line will climb a little bit higher over this weekend into next week, because I am headed to Palm Springs on Saturday to go play a little golf and buy some food, eat out at restaurants. So that will tick a little bit higher with me.
See, I thought you were going to say that this opening weekend, I think it's the first weekend that they're going full capacity at Disney World. So I thought that's where you were going. But no. Kevin Hill is going to do it by himself in the world's 7th largest economy. He's going to pick that service spending up by himself this weekend. I love it. Okay, we got one more. This one is from the Federal Reserve database. This is pallet prices, okay? This is pallet prices for wood and mixed product pallets. This is an effect of e-commerce consumption rising so quickly, and CPG companies and retailers trying to stock up and keep some buffer inventory, holding on to pallets a little bit longer. It's also a factor of lumber prices being up so high. It's a factor of trucking capacity being so tight and not being able to reposition pallets, and that rising costs as well. All in all, there are some industry sources that are citing the price of wooden pallets are up 400% year over year, and sawmills are really constrained. And right now, because the wood supply is so low and lumber prices are so high, pallet manufacturers are having to compete with home manufacturers for wood, which is not people you want to be competing with if you're making pallets. And so it's just a not good situation going on with the pallets, and there's not all that many catalysts for more supply coming online in the near future. So something to watch here in the freight industry, that is pallet prices. So that's the two charts of the day. Thanks for taking the time to do that with me. All right, Kevin, I've got buy or sell. You actually haven't done this one with me. I think this is a new segment since the last time you hosted with me. This is pretty simple. I'm going to give you a statement or a rumor, something I've heard. You tell me whether you're buying or selling it and why. All right, so this is the F-150 Lightning, the brand new all-electric pickup truck that Ford unveiled last week. The F-150 Lightning versus Cybertruck reservations in the few days after the release. It's because both of the CEOs are tweeting updates post-launch and because both companies have offered the same $100 fully refundable reservation. This is relatively comparable, I think. So we can look at it. Within the first 48 hours, Ford CEO Jim Farley tweeted that they had received 45,000 reservations. Very impressive, except when you compare it to 2 days post Cybertruck launch when Elon had tweeted that Tesla had received 150,000 reservations. He eventually tweeted after 6 days that they had received 250,000 reservations. We're still waiting on updates from Farley, but that is the chart there that I was wanting to show you, Kevin. Red and Tesla blue in F-150 Lightning. You buying or selling that Tesla reservations are 4 or 5x where F-150 Lightning reservations are?
I'm buying that they probably are. They probably are 4 or 5 times X or 4 or 5X what Ford is. I'm selling if it means anything or not. I don't think it really means a thing. I think Tesla brings in a lot of the fans, right? The fanatics, the people who are wanting part of that community, and that it's going to push in or push up those order numbers. Ford, the Ford pickup truck, whether you like it or not, is the #1 seller year in, year out. So it's not going to create as much of a buzz as Elon Musk can do on his own. But I still don't know when the first delivery date for a Cybertruck is.
Yeah, probably early 2022.
Ford beat them to the first truck on the market?
I don't think so. I don't think they will, but they'll beat them. They'll beat them on volume for sure. And that's the reason that I'm also literally on the exact same page. I am buying that the reservations are much higher. I am selling whether it matters, because I also think about how the companies are constrained. Tesla is going to be very constrained making these Cybertrucks. They're making a brand new product. They're buying 10,000 pounds or 10,000 ton casting iron machines to make them. It's going to be very difficult to make them. The F-150 is built on a very similar system that it's been built on for 100 years. The volume there is going to be much higher, so you don't really need to have a reservation for it. They're going to be available when they come out. So yeah, I'm buying, but it's not really that important. Okay, let's get on to You Care or Not. We've got 3 quick ones here. The first one is on Peloton. Peloton has announced that it will invest $400 million in its first U.S. manufacturing facility in the U.S. That is notwithstanding the 2 facilities that they bought from Precor that they are currently trying to refurbish and get them online in the back half of this year. But they're going to build their first one, $400 million, just south of Toledo. Going to be 1 million square foot. Going to have 2,000 jobs in the area. You care or not?
I do care. Peloton is manufacturing in the U.S., which is really great. I guess this is maybe a knee-jerk reaction whenever you start having to load Peloton bikes onto air charters and fly them in from Asia. That's pretty expensive. Maybe it's more expensive to do that and to have that risk of your supply chain than it is to invest in manufacturing close at home. Real estate is always good to have too.
Yeah, I am 100% with you. I love this. I think the further away we get from this recall, the more it's going to look like a blip on their radar. They've been manufacturing most of their stuff in Taiwan, and they really kind of erode some geopolitical risk here, not having to ship some in. You remember back, I think it was in November, they announced that they were going to invest $100 million into their supply chain. More or less, they were just spending $100 million to air flight their stuff in. Think about this. They're only paying 4 times as much as that in a long-term investment that's going to give them manufacturing capacity for decades, going to be able to build all of their products right now, plus more products into the future. I think it's a good move.
I do too, because that's real investment. $100 million
Exactly.
you spend on air charters to fly in Pelotons is not, I wouldn't call that an investment. That's an expense on the income sheet.
Yes, absolutely. Okay, let's get on to number 2. This is Authentic Brands Group. This is a firm that's been on a tear buying up bankrupt retail properties, in part in a joint venture with Simon Properties. They are looking with potential advisors on a potential IPO that could come as early as this year, according to a Bloomberg report that cited anonymous sources. Kevin, you care or not about ABG possibly going public?
I do. I love the business model. This is drop shipping on a massive scale. That's all it is. It's all these Shopify ads getting people into drop shipping, where you're selling a product and it's delivering from somebody else, someone else is manufacturing. You're basically outsourcing everything, kind of based on the 4-hour work week, that whole book. But this is just that at scale. And you're outsourcing everything. You're just marketing the product. I love the business model.
I knew you would. That's why I brought this up. This is your type of business. This company literally just buys up once very prominent retail brands. The likes of last year, they bought Lucky Brand, they bought Brooks Brothers, Forever 21. This year, they bought Eddie Bauer. They bought Barney's and Nine West in the past. They bought these for pennies on the dollar. Mm-hmm. They literally just market it They license out all the manufacturing, all the retailing, and then they sale lease back all the valuable properties, and they just squeeze every penny left in that company. And it's very profitable. It's a highly profitable business.
It's like owning all these 7 or 8 retail department stores or former retail department stores and brands, and maybe running out of office where you have 20 people who are actually employed by you. Everything else is outsourced. Outsource the manufacturing, the design, everything. I love that business model.
Yeah, it's a good one. It's a good business. Yeah, check it out. It's probably going to be the ticker ABG sometime later this year. Okay, last one. This one's on FedEx. I know our guest, Dick Meltzer, is going to have some thoughts on this, so we'll bring him in here in a moment. But FedEx will increase 3 peak surcharges on express and ground shipments beginning June 21st. Affected surcharges include the additional handling surcharge, a residential delivery surcharge, and a peak surcharge on ground economy. Kevin, you care or not?
Yeah, you always have to care about surcharges when it comes to parcel, right? Because that's kind of a bellwether of surcharges coming into the economy. I know back in the day when fuel prices were crazy, the fuel surcharge, surcharges really dictated what the capacity was going to be. So these surcharges, definitely, yeah.
Yeah, I do care about this one as well. Sorry, I got 3 today that I care about all 3 of them. But I do care about this one because it's a very significant bump. They are raising the surcharge on residential, the peak residential, from 30 cents to 60 cents per package, so doubling the surcharge for digitally native online brands that ship a lot through UPS or through FedEx rather. That is expensive, and that's going to add up, and it's going to hit the bottom line. So yeah, I have to care about this one. And let's bring in Mr. Meltzer here because I'm sure he has some thoughts on these FedEx peak surcharges. He had a post on LinkedIn, I think it was yesterday or the day before, talking about it. Dick, thanks for joining the show. Welcome. And let's talk a little bit about these surcharges. What are your feelings on I guess it's Christmas in June, it seems.
Yeah, Christmas in June. It's wild. The peak season surcharge start this early this year. We haven't decided what we're going to do yet, but I'm not going to start it in June. I mean, it's just seems at odds with everything. That I mean, how do you justify it? How do you really justify that it's peak season in June? Pretty soon they'll have surcharges for Groundhog Day and, for things with sharp ends and, the every other Thursday surcharge that continues until further notice surcharge, I think will come next. I'm joking, but look, they're doing the right thing for their shareholders. I mean, as was commented during the show, that they're doing extremely well. So is UPS. The question is, do they have a day of reckoning coming? Not so much from the regionals, because we're 5 to 7% of the market, depending on whose numbers you like, but more from Amazon. When I don't think it's a question of if, but when Amazon gets into direct competition with FedEx and UPS, that becomes a different story.
Yeah, let's come back to Amazon because that's something that I've been writing about in a lot in the last few weeks. I mean, Amazon makes up 13% of UPS revenue. They're spending CapEx 4 times as much every year building out that logistics infrastructure. But I want to jump back to a comment you made about the 5 to 7% of the market because that is one of the questions I had was, how big is the regional parcel market? And, you said that UPS and FedEx are doing very well. Obviously, they're doing their best for their shareholders right now. How is it going in the regional and the smaller guys?
Yeah, I mean, the regional market, it's a good time to be in the regional parcel market too. I mean, there's been a lot of customers that we've gained where FedEx and UPS either capped them last year or raised their prices significantly or just, asked them to get rid of a certain percentage of their volume. There was one customer that I know of that was with UPS for 30 years. And right before peak last year, asked them to get rid of 30% of their volume and didn't do it very politely. And so, I've been doing this a long time and, memories are long. And I think FedEx and UPS have created a visceral reaction. I talked to people who said, if we could figure out a way to punish FedEx and UPS for what they did in 2020, we would, but they can't. So that's just the reality.
So you LSO is a regional parcel. Can you give our audience a little bit background about LSO and the region that you cover and what you're seeing right now in the market?
Sure, Kevin. Real quick, LSO, Lone Star Overnight, been around for 30 years, but really in the last 3 years, we've refocused our attention on e-commerce and rebuilt the company from the ground up around e-commerce. But when people ask me, why should anybody use a regional carrier, including LSO, instead of the big guys? To me, there's 3 key reasons. One, better service, and we can document it. And there's third parties that you can go to or credible sources that can substantiate that. Significant savings, oftentimes double digit, even with the larger clients. And third is that we're a lot easier to deal with. We're a lot more inclined to do it the shipper's way versus the other way around. So, but we have been growing rapidly, especially since 2019. We've signed up, after we rebuilt the business, we signed up a lot of name brand e-commerce retailers, added more to it in 2020, and then COVID hit, and it was like an afterburner, in terms of our growth. And in the middle of that, we sold the company as well to an investor who's really helped us to grow significantly, has put a lot of money to work this year in terms of sorting facilities and technology to allow us to catch all this e-commerce volume that's coming our way.
Hey, Richard, I wanted to jump back to some of these customers that you guys are catching and getting from that have been left behind by UPS or FedEx. Are there any broad strokes to paint on what types of companies that they are excluding, or is it just kind of random and it depends on their volume and where they're located?
Yeah, I'd say that just because it's such a significant part of e-commerce, that apparel is definitely a key sector for us. Things like cosmetics, some healthcare, some home goods, things of that nature.
So you think it's more of just the things that people were buying more of online? That's what you guys have seen more demand for over the past year? Home goods, cosmetics, exercise equipment.
Yeah, it's all those types of things, and I don't think that those things are going to go away or significantly deteriorate as the economy opens up due to COVID problem being solved, which is obviously a good thing.
So, Rick, I want to talk about kind of long-term with just structural changes that have occurred or may occur from e-commerce. Like we saw the retail e-commerce data came in for April, and it was flat from March. So, no real change, but still significantly up over last year. I just wanted to ask, for retailers that are, moving towards more direct-to-consumer sales or are doing just more online sales in general, do you think long-term that the shipping costs are just naturally going to be higher as people break down from full truckload and send more parcels? Is that just going to be part of it, and you just basically have that trade-off where you get higher margin, but you're going to pay higher transportation costs?
If there were no Amazon, I'd say the answer is yes, it continues as is. That could be, the big give back for FedEx and UPS when that happens.
Kevin?
Yeah, so we were seeing a lot of, showed a chart there on lumber and pallet pricing. There's inflationary pressures all through the economy right now. How do you think that's going to affect, parcel e-commerce demand and the shipment of goods? Do you see inflationary pressures continuing, rising, or hitting a peak at some point soon?
One thing, Kevin, I was going to mention this before, is I'm on the board of a company called IGPS Logistics, which is in the plastic pallet pulling business. So it's a good time to be in that business, given what's going on with lumber. But I think it's hard to envision that inflation is not going to rear its head to some meaningful degree. Labor is our key line item, related to our master contractors. And that's our primary cost of doing business. And it just is in this industry. So I think everything is going to inflate. And at the same time, the volume that we have to carry and the efficiency with which we have to do it, which means through more automation, is everybody's reaching for. There's a lot of things that are real out there, but there's things that aren't. I don't see my 34, 32 chinos getting delivered by a drone, at least not in my lifetime, which is the only thing I care about. But kidding. But at the same time, there's valid use cases for things like drones and for autonomous, even parcel delivery vehicles. I think there's very specific use cases. It's not a question of if, it's a question of when.
Hey, Richard, I had a question. When you guys are thinking about not only you, but other, smaller regional parcel carriers, how do you guys look at technologies like drones and electric vehicles, autonomous vehicles? Does that, do you look at that as, a dream, or is that something that could be achievable to, companies of your scale in the near future?
I mean, I'm going to wait and not be on the bleeding edge of those technologies. And as they get perfected and as they become more widely accepted, we're watching those trends closely, but it's not a primary focus. Primary focus is delivering parcels the old-fashioned way, if you will, in terms of picking them up, moving them, and delivering them. It's just that simple, and that takes people, process, and technology, to really do that.
How about on the software side? Andrew mentioned, autonomous and drones, a lot of hardware and transportation. What about on the software side and driving efficiencies in regional players?
Yeah, it's a great point. We've partnered with Bring Technology for our operating dispatch optimization, and OpenForce in terms of helping us onboard, especially POVs, personally owned vehicles. And if we did not have those two, I'll go as far as to say Lone Star overnight would not exist. And we would have almost drowned our own growth if it hadn't been for those two partners. They've been great to us.
Richard, can you just tell me a little bit about the model at LSO? Are you guys contracting out your delivery drivers, or are they employees of the company? How does that work out?
It's very similar to the FedEx ISP model or the Amazon DSP model, where we've got master contractors that may have an average of 8 to 9 trucks on the road at any given point in time. And so it's a very similar model. They fly our colors and uniforms, use our systems and processes, but they manage the business day in and day out against the specifications in our agreement with them.
Actually, give us a breakdown of the regions that you run. It's Oklahoma, Texas, and a few other states, right? And the terminals that you have, and kind of the philosophy of terminals that you guys operate on.
Yeah, Texas and Oklahoma primarily, some of the eastern part of New Mexico, some of the northwestern part of Louisiana, think Shreveport, and Lake Charles. And as I said, we're expanding into most of Louisiana and also into Arkansas and Missouri. Those will get done and opened for business by September.
Richard, speaking of expansion, I just want to jump back to one point on Amazon and the way that they are investing, the way that they are coming for this parcel and trying to take as much of their logistics network as possible. Should FedEx and UPS be adding capacity, adding better service right now? It seems that when I listened to the UPS call, CEO Carol Tomé said that they are going to invest $4 billion in capex this year, but in very not capital intensive ways. So it's a lot of billing and back office type of technologies. Do you think they should be adding trucks, adding service to try to compete, or are they doing what they should be?
Well, I think they're making hay while the sun shines and taking full advantage of the marketplace. We have surcharges too, but not nearly to the degree, and the rates aren't nearly as high in many cases. Carol believes in better, not bigger. I don't know why not better and bigger. Why not do that? But clearly, they're gravitating more towards that type of efficiency. I mean, if I were sitting in Atlanta or Memphis, my wake up in the middle of the night screaming issue is when Amazon is coming. I think there'll still be plenty of room for all the regionals at that point for fill in the gaps where the big guys don't. And that's a big part of our value proposition today. I don't see it going away.
And Richard, can you talk a little bit about your value proposition? I mean, what kind of services are you guys running? Is it overnight, 2-day? What types of services you run?
It's all the same services as FedEx and UPS within our region. We're just a mini version of FedEx or UPS.
Got it. Understood. Kevin, you have anything?
Yeah, so the mix shift, we were talking about it, we talk about it all the time, Andrew and I, the mix shift between services and durables. We saw a little bit in California on a chart that we just did, threw up at the beginning of the show. When it comes to your forecast for the next 12 to 18 months, what do you see on the mix shift back to services and how that might affect freight demand?
Yeah, I think freight demand is going to continue to be strong. I mean, we're projecting 70% growth on a very strong year before for this year, and I don't see it slowing down to any meaningful degree. Is it going to accelerate at the same rate we saw in 2020? Yeah, I don't think so. But that doesn't mean that it isn't going to be a high growth environment for trucking and look at what's happened with ocean freight and things of that nature. I've had some time in both those sectors, and so I think the demand for direct to consumer is going to get nothing but stronger. Retail's going to rebound, no doubt about it. But I think that's the demand's going to be continue to be high, just not as high.
Yeah, I agree with you on direct-to-consumer for sure. I also wanted to talk about some of the new fulfillment methods, whether it be BOPIS and buy online, pick up in store, and buy online, pick up at curbside. But really, the big one here is ship from store. We're having Target and Walmart and all of the best-in-class retailers, Best Buy, also leveraging this model to a big degree, shipping more than 50% of their online orders from store. I wanted to know, are you guys building that into your network? Do you also pick up some parcels from stores? How does that work out for you guys?
Yeah, we do. We like ship from store. I mean, we have stores that during peak season did 2,000 packages, and it's a tough model to scale. When it's all said and done. Now, I think some of the names that you mentioned, in terms of Target or Dick's, have invested in material handling to put in the stores and move the walls, back to accommodate that. That's a different story. That becomes more scalable, but it's still nowhere near the cost to fulfill in a high-speed, highly automated regional fulfillment center.
Yeah, it's crazy to me, the numbers that we get from Target. Their CEO and CFO, and they always talk about how, for them, the difference in cost from shipping from a fulfillment center and doing ship from store, or rather having somebody pick up in store. I think it's 40% cheaper for them to have somebody come to the store and pick up than it is for them to ship from the fulfillment, simply because of that last mile cost. Being able to eliminate that last mile saves them 30-40%. Mr. Meltzer, I apologize, but I've got to wrap this up. We are coming up on the end of my show, but I do want to give you a moment to tell anybody in the audience where to go if they want some more information on LSO.
Yeah, sure. Just go to rmetzler@lso.com or ring me at 510-719-8380. But thanks, Andrew and Kevin. Really appreciate the time.
Yeah, we appreciate you coming on and giving us some insights, learning a little bit about regional parcel carriers. Thank you so much. We'll talk soon.
Thanks, guys.
Thank you.
All right, that was interesting. I mean, because I guess I hadn't really conceptualized it yet, that there are companies that run FedEx model, UPS model, but in one state or in 3 states and do it really well, and they're able to focus in on a niche area. Like we talk about this all the time, niches are where the riches. That is like one of the things you taught me, right? And we don't think about it on a logistical scale, but I guess it is possible. And as Dick just said, they do it.
It is. It's all about density of network. In full truckload, especially in LTL too. So you keep your region smaller, right, in your niche, and you can really pack in the density.
Right. I like it. Good stuff from Mr. Meltzer. All right, that has been all we've had today for episode 71 of Great Quarter Guys. We are back live next week, same time, 3 o'clock Eastern. If you watched live, thanks for joining us. If you are watching on demand, subscribe to Great Quarter Guys wherever you listen to podcasts, or subscribe to Freightcast. See you next week.